Silver just dropped 16% in a single month, from above $70 an ounce down towards $64. And if you've been holding silver, that number probably feels like a punch in the gut. But here's the question nobody's actually asking. Is this a crisis or is this a setup? Let's get into exactly what's driving this move, because it's not random. Nothing in markets ever is. Silver rose to around $65.20 an ounce on June 22nd. Technically a recovery, but still sitting 16% below where it was just a month ago. Trading economics. Meanwhile, the all-time high for silver this year was $121.62, hit back in January. Gold silver. So from peak to recent trough, silver has been cut nearly in half. That's not a dip, that's a correction. And understanding why it happened is the only way to know whether you should be scared or excited. Let's start with the Federal Reserve, because this whole story begins and ends there. The Fed, now under Trump White House appointee Kevin Warsh, left rates unchanged, but the tone was anything but neutral. New U.S. jobs data blew past analyst forecasts, driving Fed rate expectations sharply higher. Bullion vault. Here's why that matters for silver specifically. When traders start pricing in rate hikes, real yields go up. And when real yields go up, assets that don't pay interest, like silver, like gold, become less attractive relative to bonds and cash. Money flows out, prices fall. It's a mechanical relationship, and right now it's working against silver hard. 9 of the Fed's 19 policymakers now anticipate at least one rate increase this year, with investors pricing in a potential hike as early as September. Trading economics. 9 out of 19. That's almost half the committee leaning toward tightening. The dot plot split the committee almost down the middle on rate hikes. The dollar surged to its highest since May 2025, and silver posted its sharpest single-week drop in months, gold silver, before recovering about 2/3 of those losses. Now here's where it gets interesting, because Warsh didn't just hold rates. He changed the entire language around how the Fed communicates. In Warsh's framing, forward guidance language was stripped from the policy statement entirely. The Fed is done telegraphing. It responds to data, not its own projections or communication strategies. Gold silver. That's a massive shift. It means every inflation print, every jobs report, every PMI number now carries more weight than it has in years. Markets can't pre-position the way they used to. That uncertainty gets priced into volatility, and silver, which is more volatile than gold by nature, feels it first. So let's talk about where silver actually sits right now relative to gold, because the gold-silver ratio is telling us something important. With gold at $4,165 and silver at $65.24 as of June 10th, the ratio sits at approximately 63.9, up sharply from 55 in May. A rising ratio means silver has cheapened relative to gold. Gold-silver. Here's the historical context. The 50-year historical average on the gold-silver ratio is 65 to 70 to 1. During active precious metals bull cycles, the ratio typically compresses toward 40 to 50 to 1 as silver outpaces gold. Gold-silver. So at 63.9 right now, we're not at an extreme. Silver isn't screaming cheap by historical standards, but it is cheaper than it was. And if this bull market in precious metals is intact, the ratio compression trade still has significant room to run in silver's favor. But here's what a lot of people watching silver miss. Silver isn't just a monetary metal. It's also an industrial metal, and those two demand engines don't always move in the same direction. Silver's monetary engine, real yields, dollar direction, inflation expectations, moves alongside gold. But the industrial engine, solar panels, electric vehicles, AI infrastructure, electronics, follows its own cycle. When rate hike fears suppress the monetary engine, silver tends to underperform gold in the short term, but industrial buyers don't pause for Fed decisions. That demand continues regardless of rate expectations. Gold-silver. Think about what that means. The same silver sitting in an ETF that investors are selling because of Fed fear is also being consumed in solar panels and AI data center components at a pace that doesn't slow down because Kevin Warsh sounds hawkish. The global silver market is heading for its 6th consecutive annual supply deficit, 46.3 million ounces, wider than the year before. The deficit is expanding because mine supply is contracting faster than industrial demand is falling. Gold-silver. 6 consecutive years of deficits. That's not a short-term story, that's a structural story. Now I want to bring in the dollar here because the DXY, the US dollar index E, is the engine room for everything happening in precious metals right now. A stronger dollar makes silver, which is priced in dollars, more expensive for buyers using other currencies. That suppresses demand. Over 12 to 36 months, The negative correlation between the dollar and silver is one of the most reliable patterns in the market. With the U.S. fiscal deficit near 6 to 7% of GDP and debt to GDP above 120%, the structural conditions for sustained dollar weakness are firmly in place. Gold, silver. The dollar is strong right now because of rate hike expectations, but the underlying fiscal math on the United States hasn't changed, and historically, that fiscal math wins over medium-term horizons. Let's talk oil, because that's the wild card that's been complicating everything for precious metals investors. The last several months have been like that, day-to-day headlines swinging from one end of the spectrum to the other. A US-Iran peace deal gets signed, silver pops 2.8% in a session, then the FOMC's rate hike signal reasserts itself and silver gives it all back. Yahoo Finance. That pattern tells you exactly what's happening. Geopolitical fear was driving both a safe haven bid in silver and an inflation premium in oil. Now that geopolitical risk is partially easing, the safe haven component is deflating. But the inflation component from elevated oil is still there, keeping the Fed's finger near the rate hike trigger. The development helped ease market concerns after both sides recently exchanged threats over the conflict in Lebanon, with Tehran claiming it had once again closed the Strait of Hormuz. However, millions of barrels of crude continued to pass through the waterway over the weekend while Persian Gulf producers prepared to increase output. Trading economics. So the closure threat didn't actually hold. Oil is not running away. And that matters because if oil stays controlled, inflation expectations start to fade, and the case for a Fed hike weakens. That's the scenario that sends silver back up. Now here's the number I want you to hold in your head, because this is what nobody's talking about. Silver's 7.17% single-session decline on its worst day this month reflected its dual nature. The dollar strengthening is bearish on both its monetary and industrial sides simultaneously, and silver's higher volatility relative to gold produces amplified moves in both directions. Appreciate both directions. That's the key phrase. Silver doesn't just fall harder than gold, it also recovers harder. And right now the market is obsessively focused on the downside volatility without pricing and what the upside looks like when the narrative flips. What does the flip look like? Derek Ned, founder and CEO of Ridgemont Metals, said it directly. Silver runs hotter than gold both ways. If we get any resolution on the Iran front and the dollar weakens, silver snaps back fast. Then getting back to $90 and holding there is a very realistic outcome. CBS News. $90. That's roughly a 38% move from where silver is trading right now. And the bear case he put on the table? With the amount of demand for solar and AI infrastructure, I really don't ever see silver trading below $60. CBS News. So let's think about asymmetry for a second. If Ned is right, you're looking at a floor somewhere around $60 and an upside case back toward $90 or beyond. That's a 3-to-1 asymmetry in favor of the bull case, assuming the structural story holds. And the structural story? 6 consecutive supply deficits, AI and solar industrial demand, central bank accumulation, a dollar that faces long-run headwinds, hasn't changed. What's changed is the near-term rate narrative, and near-term rate narratives change faster than structural supply deficits do. There's one more thing I want to flag before we close out, and it's the event that actually determines where silver goes this week. The Fed doesn't watch CPI, it watches PCE, and the May reading drops Thursday, June 25th. Here's the mechanism. This one number links directly to gold prices, rate hike odds, and what long-term holders need to understand before the week is out. Gold, silver. If PCE comes in cool, below expectations, the rate hike narrative cools with it. The dollar softens. Silver bounces. If PCE runs hot, you get the opposite. The Fed looks more justified in hiking, the dollar holds its gains, and silver stays under pressure near $64 to $65. That is the binary that every silver investor needs to be watching on Thursday. Not the day-to-day noise, not the geopolitical headline of the hour, the PCE print. That's the game this week. So here's where I leave you. Silver has dropped 16% in a month from a position where it was still up 80% year over year. The Fed is hawkish but split. The dollar is strong but structurally challenged. Industrial demand is steady. The supply deficit is widening. And Thursday's PCE number is the next major catalyst in either direction. Should silver investors be panicking? That's what I want to know from you. Are you holding, adding, or getting out? Because right now people are making very different calls on the same set of facts, and I genuinely want to know where you're sitting. Drop it in the comments. And that PCE number dropping Thursday, the one that could flip the entire rate hike narrative in 48 hours. That's exactly what we're breaking down next time. You won't want to miss it.